welcome to the Payback Live Training Call. On this call, we're going to talk about terminology for IULs, and we're also going to talk about how this can apply to everybody. One of the main things that new agents have a problem with is the actual, what does this mean? Is this important to know? Is this important to know? What does this terminology mean, and how do I explain it to my client? So we're going to start off. I recommend that if you have a pen and paper, write these terminologies down. If you don't understand it completely after this training will be on my YouTube channel. You can always Google the terminology and it'll give you a more in-depth explanation. There's other IUL experts on the internet as well. You can watch videos on it. Doug Andrews is a real it has been doing this for many years. You can look him up, Google him. He'll explain the terminology in more detail, sometimes too much detail, but you can definitely get more knowledge that way. So first off, the first word is indexed, right? What is an index? An index is a conglomeration of mutual funds, stocks and bonds that are in one big index that our cash value is going to ride against when it comes to an IUL, right? So as we have cash value, as that index goes up, then our cash value is going to participate in that index. But when the index goes down, that participation is taken out. And the reason why is because the carriers use stop options to invest in the index. Okay. And so when the index is doing great, we participate in that in an IUL. When the index is not doing great and it goes down, then we don't participate. It's automatically triggered to just stop and pull out of the index. Okay. The next one is an illustration. Okay, we're going to go over all the basic terms of this so people can completely understand. An illustration is basically a spreadsheet that shows a projection of what their funds can do in an IUL based off of today's rates. Meaning that I always tell my clients, it's just an illustration. It's nothing set in stone. And the reason why is because we don't know what the future is going to do. So as an example, National Life Group, their illustration illustrates at 6.44%. Now, is the market going to stay at 6.44% every single year for the rest of our lives? Heck no. We do know two things are a fact. The market is not going to stay exactly the same, and the market will go up and it will go down, right? So that's what an illustration is. Cap rate. Some IULs have a cap rate, okay? A cap rate is the amount that you can, how do I put this? It's the amount of interest that you can accumulate at the maximum rate that they have, right? As an example, Americo has a cap rate of 15.25% on their IUL. Mutual of Omaha on their IULE has a cap rate of 9.25%. That means that if the market does 12%, you get 12%. If the market does 18%, you get 15.25% if we're talking about Americo. Okay. Now, some carriers, they don't have a cap rate. NLG has some products, some indexes that does not have a cap rate. And so if the market does 12%, you get 12%. If it does 22%, you get 22%, right? Now, why do they do this? That way it hedges their loss, right? If there's any loss in the market, and the way I explain it to my clients is that, look, you don't get any loss. If it goes below zero, you get zero. You keep all of your money. You don't lose anything. Right? But if the market goes up, they get to participate in the gains up to the maximum cap rate. Okay. Point to point. A lot of these indexes, you'll see point to point. What does that mean? That means from issue date to issue date. I like to call it an anniversary. Everybody knows what an anniversary is, right? It's simple terms. If we keep it simple with the client, they're going to understand it a little bit better. Keep it simple, stupid. KISS, right? So I like to call it an anniversary rate, and that means that the day that they get it issued, they get approved and then it issues, 1 year from that date, they don't participate in every month in between. What happens is on their anniversary date, 1 year from that date of issue, they're going to take a look at the market. And if the market is doing 8.4%, they're going to get 8.4%. Okay. And then the next point to point is the next anniversary date. If the market did 12.5%, they're going to get 12.5%. That's what point to point means. Okay. The next one is called crediting rate. Crediting rate. It's the amount of crediting that the insurance carrier will give you credited into your account. And that is another word for interest rate, right? Participation rate. What is participation rate? I like to call it a supercharger. It allows the carrier to adjust how much of your cash value is participating in the interest rate, right? So right now, NLG has a 235% participation rate on their past setter index, okay? So if the market does 10%, you multiply that times 235% of a participation rate, and that equals 23.5% that they would have credited to their account. Okay. So it's like a supercharger. If the market does 10%, a lot of IULs that don't have a participation rate, you get the 10%. If it has a participation rate, they get that percentage rate times the participation rate, and that is what is credited to their account. Americo has a 80% participation rate, just to kind of give you some perspective. Okay. The guaranteed value, alternative value, non-guaranteed values. So guaranteed value, alternative value, and non-guaranteed value. So what I'm going to do here is share my screen. And then I'm going to explain this one by going into a illustration and talking about that. Okay, we're in an IUL for NLG. Now, NLG, this is an illustration for a 52-year-old standard non-tobacco by the name of Billy Bob Holmes. And his initial premium is $232.17 a month. Okay. His death benefit protection is $94,790. So when I explain this to a client, the first thing we always want to explain is the guaranteed illustrated value. And then, and the way I explain it is I'll say, I'm going to spend a little bit of time on the guaranteed illustrated value. I'm going to spend a little bit of time on the alternative current illustrated value. And then I'm going to spend the majority of our time on the current illustrated value. Okay. And then I go right back up here and I'll say, okay, whoops, I went too far. I'll say, okay, guaranteed is exactly what the guaranteed is, right? I like to think of it as Armageddon, worst case scenario. This is the amount of money, cash value, that you're going to accumulate no matter what if the market tanks over the next 20, 30, 40, 50 years. Okay. And I'll show them that after 10 years, you'll have 27,000 in here, and then you'll have a $7,214 cash value. Okay. We're going to go over those terms here in a minute as well. Then I'll come down here and I'll say alternative current value. The state of Nebraska wants us to show you what happens if the market performs less than the current illustrated value. And so this shows you that after this shows you at a interest rate of 3%, okay, you'd have 27,000 in it after 10 years, okay? You're going to be 61 years old, and then you're going to have about 17,000 of cash value, okay? Then I come over here and I'll say the current illustrated value is about 6.44%. After 10 years, still the same, you got $27,860 in it, and you'll have $20,592 in cash value. Okay. And so this is the current illustrated value. This is currently what it's doing, what the market is doing right now. And the alternative is a lower projection of what what could happen over the course of time. And so I usually just show them the first 10 years, and then we stick right around here. And if they want to see this, a lot of times I'll just show them that, look, if it does exactly 3% over the course of, the next 20, 30, 40 years, that at 83, you're probably not going to need this policy at 83 anymore because it's going to lapse. Okay. That's if it does 3% every single year. Here, if it does an average of 6.44%, it's going to cover you for the rest of your life, all the way to 121. At 121, it doesn't work anymore. And the reason why is because no carrier covers anybody over 120 years old. Okay. So that's how you explain the current illustrated value. And a lot of times what I do is I'll kind of let them know that, most carriers under promise and over deliver, right? So this may be a little bit low right now and it may go higher. But if the market does lose money, you get to keep all of your money because it doesn't go below zero. Okay. Now, the next one is accumulated value. That's this column right here. Accumulated value. Accumulated value is the amount of cash. It's the cash portion of your payment that is going into the market. In a monthly payment that the client makes every single month, depending on how the policy is structured, a portion of that payment goes to the cost of insurance, and a portion of that payment goes to the cash value account. The cash value account is the accumulated value account. Now, this account is the amount of cash that is indexed against the market, not the amount of cash that you can borrow from. Okay. This column right here has nothing to do with the amount of cash that you can borrow from. Okay. This column, the cash surrender value, is the amount of cash that you can borrow from, not the amount that you've accumulated over time. Okay. So if you look, the way I explain it to my clients is I'll say, okay, the first 5 to 10 years, I let them know right up front, this is a long-term play. This isn't something that you're going to just go and invest in unless you have a big lump sum of change and you're going to take the money out in a year or two. You have to build it up so that you can borrow from it. Okay. So the first 5 to 10 years, you're really building this policy for your family. And then after the 10 years is up, you start really, really compounding and building it for your family and for yourself to grow cash value. And so I'll ask them, do you notice that the amount you can borrow from is lower than the accumulated value? And of course, the answer is yeah. And I'll ask them, do you know why? And every single time they're going to say no, right? And the reason why is because your cost of insurance for this death benefit of $145,000 for all the living benefits that come with it is front loaded in the first 5 to 10 years. Okay. And it's starting to get a little bit more evened out from 5 to 10 years, but it's really front loaded in the first 5 years. Okay. And if you look by year 11, it's now evened out. Okay, so all their cost of insurance now, if they surrender the policy, the carrier's not going to lose any money. Okay, and that's why it's front loaded. Okay, so that's cash surrender value, and that's accumulated value. Okay, MEC premium. MEC, M-E-C, stands for Modified Endowment Contract. Now, where do you find that? Well, down here on the very, very bottom, we're going to use NLG as an example. You can see the MEC premium. This is almost the last page. Well, actually, it is the last page. The MEC premium is right here. What is a MEC? MEC is again, it's modified endowment contract. And what that means is if you pay more premiums than the cost of insurance allows per the IRS rules, then it will become an investment. And if it becomes an investment, it's now a taxable event. And so they don't want to pay over the MEC premium. And this is per year. So in this case, if this gentleman, Billy Bob Holmes, wants to max fund this policy, he can pay up to $11,560 per year without it turning into a MEC. Okay. The guideline, where are we at here? Guideline level premium. This is calculated over a long period of time. And it basically says that, look, the guideline level premium, if you pay this amount of money per year over the course of 20, 30, 40, 50 years, your policy will the illustration should act as if, let me rephrase that. The illustration should do this or better over the course of many, many years, not knowing what the market is, right? But it's calculated over until you're 90, in a minimum of 20 years all the way up to age 90. And that's what that guideline level premium is. It calculates it over a long period of time. Okay, guideline single premium right here. This is the amount that they can pay in up front to consider it a life insurance policy over the course of 11 years. So in 11 years, they can pay this amount of money and be done with it. And so they can literally pay this in for 1 year. If they want to do a lump sum in 1 year and pay $63,339 in 1 year, they can do that. They won't be paying any more in for 11 years. After 11 years, as long as they stick to their payment, they can still keep funding it. Okay. Why 11 years? I don't know. It's what the IRS set up back in 1980. Okay. Target premium. This is the cost of insurance calculated over about a year's worth of time. That's the cost of insurance out of the payment that you make, that the client makes. So if they're paying, $200, like this guy's paying $232 a month, times that by 12, right? And that's your annual premium. The cost of insurance out of there is going to be your target premium. And that's what your commission is based off of. That's how you get paid. Okay.
Shawn,
So
can you go over the guideline single premium again?
the guideline single premium is the amount they can pay in 11 years to keep the policy active without becoming a MEC.
And they can do that as a lump sum?
They can do that as a lump sum, but they can't go over that. And here's the thing. The carriers safeguard this because they don't want it to MEC for you either. So the carrier is supposed to refund you back any money that's an overage if it becomes a MEC policy.
Okay.
So the carriers have those safeguards in place. They'll just send you a refund back and say, oh, no, that's too much. You can't pay that in. Okay. So who qualifies for these policies? Really, as long as they're, per the carrier's ramifications, as long as they're of age, in between the age of their requirements, like I think America has the age of 20 to age 70. And then NLG, you can get a policy for somebody that's 15 days old, all the way up to, I believe they go up to age 75. Okay. And as long as they qualify with health through the health requirements, they can do that. They can do an IUL, right? The amount of money that they put in doesn't really matter. Okay. Now, I get some people that are like, well, how can you get an IUL on a 50-year-old for $50? Well, it really all depends on the cost of insurance, right? Can you get an IUL for $50? If they want an IUL that's going to, only last for a couple of years and lapse, yeah, maybe. But why would somebody want to do that, right? It really all depends on the cost of insurance, and it depends on what they're looking for. Do they want to grow cash value? Do they want to have a death benefit protection type of a focus? And in that case, I would go into Americo if they do want to have a death benefit protection type of focus. So I have one drawn up with Americo right here. Let me move this out of the way. So this guy is paying $200 a month, right? And they use the S&P 500. They don't use a pass setter, okay? And he's 52, same age as the other one. And for this particular series, well, let me show you something here. So he wanted to pay $200 a month for $145,830 death benefit, okay? With AIG or NLG, this one was $145,830, same amount, but his cost of insurance is 232, or his payment is $232.17 for the same amount of coverage, right? So here he's going to grow a little bit. Let me see here. Let's go back up here. We're just kind of explore this together. I didn't look into deep into this before we got on the call here because I wanted to kind of do this together with you guys. So if you look, it's the same amount for 145,830. He's paying in 232 with NLG. He gets a death benefit of 145,830. And in 10 years, he'll have cash value of 20,592. Remember this number, guys, 20,592. And by the time he's 71, he'll have 62,666. So write that number down because we're going to compare that to the IUL with Americo. So we come over here. Let's look at Americo. For $200 a month, a little bit cheaper, he gets the same death benefit. Okay. Now, if we come down here, so this is an Americo illustration, by the way. All you would do, oh, I got to re-log in here. Give me a second. Okay. So all you would do, it's got the wrong numbers in here, but well, let me just plug this in. All you would do is plug in the information and then click the little button at the bottom that says create illustration. And do you guys know how to do that, by the way? Nod your head if you do. If you don't, I'm going to show you. You already do. Okay, cool. So down here, and here's the button right here, create report. So down here, you can change the allocations as well, right? So here's S&P point to point with the participation rate. So this only does 80%. What I like to do is I put them at 0% for that and 100% for the point to point with a cap. Now this will give them a 15.25% illustration or cap, but they get 100% of our participation rate. So if the market does 12%, they get 12%. Okay. If you do the participation rate, if the market, there's no cap. Okay. So if the market does 18%, they get the participation rate on the IUL for Americo is 80%. So if the market does 18%, they'll get 80% of 18%. Okay. You guys follow me on that? Yes, no? Okay. All right. So that's kind of how that one works. I like the cap better because that way they get 100% of every participation rate, right? If the market does 10%, they're going to get 80% or 8% on an 80% participation rate. Now, these IULs across the board aren't designed to beat the market. They're not designed to get high rate of returns. The average rate of return on an IUL is about 7 to 10%. So if I look at it and I'm like, okay, if the market is doing on an average of 8%, 8.5%, and they have an 80% participation rate, that's going to give them a lower rate of return. Whereas with the point to point with a cap, they get 100% of that, but they get up to 15.25% of the cap. Okay. So if the market does 12%, they're going to get that 12%. Right. So I like to put them in with the cap right here. Okay. So over here is the illustration. Now this is the very top of it. So I'm going to kind of go through this a little bit so you guys understand the riders, and this one has it at the participation rate. Let me redraw this real quick here. I forgot to change that. Okay. And then we'll close this one up. Okay. And you guys can go in there and play with it and just run illustrations to practice. So I recommend once you run an illustration, read everything on the illustration. Understand what it means. Take a half an hour to learn everything on the illustration. Take a half an hour to learn everything on another illustration with NLG. Because once you learn it, then you can explain it. And once you learn it one time, then if you forget something, you just go back and review it. But that's part of the process, right? If you guys understand it, then you can explain it better to the clients. See? Oh, I said 80%. It's 86%. I'm sorry. So in here, the current is 15.25%, okay, with the cap. So we'll come down here. Here's all your benefit riders. So if you want to share your screen with them, you can just kind of walk them through all of this and say, look, it comes with living benefits. You know, you got life insurance protection. You know, it's a company you can trust. A rating with the excellent by the AM Best rating is an A rating. So then you come down here. You can go through all of this with your client. Here's it goes into living benefits a little bit deeper. Critical illness, accelerated death benefit, right? And this kind of goes into what happens if in the last 12 months you have ALS or kidney damage, cancer, major organ, heart attack, stroke, right? Chronic illness, you can explain it right here. Terminal illness, you can explain it right here, okay? So down here explains the participation rate, indexing, and it also explains the cap. And then down here, this is your S&P index, and they do a 25-year look back. Okay, and so I explained it to them that, look, on this column right here, this is the actual of what happened with the market in the S&P right here. And then I just kind of go to the column that we're talking about. I don't explain the participation rate column because we're not talking about that. We want to keep it short and simple. And so in 1999, they did 15.25% because the market did 19.53. You got a 15.25 cap. But the next 3 years in a row, it went down. Guess what? You got to keep all of your money. In 2003, went back up 15.25. And then I'll just kind of point out some years. This is what it did on average, right? But guess what? You don't lose any money, okay? So then I explain right here, here's a 5, 10, 20-year, you know, age ratio. And then 18-year. I don't know why they have it out of order. That's interesting. So here's the guaranteed. Here's your non-guaranteed. And then here's your non-guaranteed current illustrated rate right here. Okay, and this is the amount of cash they would have in there, the surrender value. The surrender value is also, remember, it's the amount of cash that they can borrow from, but it's also the amount that they would get if they were to surrender the policy. Okay. So if we look down here, and then here's your guaranteed right here. So again, the way I would explain it to them is I'd say, okay, here's the guaranteed. We're going to spend a little bit of time here. Then down here is your alternative. We're going to spend a little time there. And here is your current illustrated value right here. We're going to spend most of our time here. Okay. Then again, I would explain what guaranteed is. Make sure that they understand that's worst case scenario. Alternative, this is a lower rate than what's being illustrated. And then the non-guaranteed illustrated rate is what's currently the market is doing right now. Okay. And I'll explain to them that after a year, you'd have 10 years, you'd have 24,000 into this. You'd have $13,158. Okay. Now, do you guys remember the numbers that I told you to write down? If we come over here to the illustrated rate, what did we say? 20,592. So here it illustrates a little bit better. They'd have a little bit more cash value in this with the same death benefit. Okay. Because they'd have 27,000 into it. They'd have more money into it, but that's why they'd also have more cash into it, because this cost is going to be $232 for this amount of death benefit. Over here, it's $200 for this death benefit, but they get a little bit less cash. Let's look at this. 20 years later, 48,000 into this, they got 38,700 in cash. Okay. And this is also based off of 8.42%. Here, they have 62,000 in cash and 55,000 into this, and it's based off of 6.44%, right? So higher rate of return, lower cash, right? So people may ask, well, why do I have less cash value when there's a higher rate of return for this carrier compared to this carrier with a lower rate of return and a higher cash value, right? Why is that? Well, it's the way that the carrier gives you the cost of insurance, right? The cost of insurance for NLG is going to be lower than the cost of insurance for America. Now, do we have to explain that to each and every person? No. Am I going to have each carrier open for them to decide? No. We want to keep it simple and stupid, right? So simple that they can understand it like that. You give somebody multiple choices. This whole training is just for you guys, right? We give people too many choices and they're not going to decide. They're going to want to say, I want to think about this. Send me these illustrations. I want to take a look at them. I want to read everything over, right? And you're still going to get that when you have an analytical person, okay? So here's the rule of thumb. If I have a mortgage protection client that doesn't know anything about life insurance in general, they just want to make sure that, to protect their family, right? Most clients don't know anything about life insurance. They just want to make sure that if something happens to them, that their mortgage gets paid for, or their family is protected, right? If they can qualify based off of the health guidelines for an IUL, I'm going to show them an Americo IUL, right? Because the focus here is based off of the amount of death benefit that they can get to cover their mortgage. Now, here's the best part about that is because a lot of times when people are wanting to cover their mortgage, they don't understand how they can grow cash value and cover their mortgage. And so when you explain to them that, look, for this price, we're going to cover your mortgage, you're going to get all of these living benefits. So if you get hurt, sick, or injured, you can pull from the policy while you're still alive. But even better than that, how would you like to grow some cash value that's going to be tax-free based off of what the market is doing? And guess what? You'll never lose any money, right? If you kind of explain it to them that way, then they're like, oh, well, yeah, I'd love to do that, right? Now, do you have to share your screen with everybody? No, no. Now, on the flip side of that, if I have a client that is specifically coming into me, if it's a lead coming into me that says, I want an IUL so that I can grow cash value, now I'm probably not going to use an Americo IUL unless their payment that they can afford is a lot lower, right? Maybe $100 to $200 a month, right? And the reason why is because I want to get them coverage right away for one. Not only that, with an Americo IUL, it's super simple and easy for them to understand. And on top of that, if we go with like an NLG policy, they're going to have to go through, you know, underwriting. And that's the big issue with NLG. So if you have a client that is willing to put in 400 or more and they want to grow cash value, then I would run an NLG illustration in a heartbeat for them so that they can understand the cash value. Now, I want to do that for you guys real quick. This is a protection focus IUL with NLG. This over here is protection focus as well because they're focused on a death benefit protection. So right here, let me go into NLG's platform here, and right here, here's your protection focus, same thing. Now what we're going to do is come over here and put in minimum death benefit, max cash value. I got to re-sign in here. Okay, there we go. So we're going to come in here. I'm going to open up that same illustration. We're at protection focus right here. Now, what I'm going to do is I'm going to click this button. You're going to see all of this disappear right here. And the reason why is because they're going to say, okay, now we're going to tell the software, okay, based off of the monthly payment that they want to pay, what is the lowest cost of insurance I can get compared to growing that cash value, right? So if we think of a teeter-totter, right? The protection focus is one side up, paying roughly, who knows the exact numbers, 75% of their payment goes to the cost of insurance, where on the downside, 25% of that goes to the cost, to the cash value account. Now, if we flip that teeter-totter and go this way, that's what the minimum death benefit is and max cash value, where 75% of their payment goes to the cash value and 25% of the payment goes to the death benefit protection and the living benefits, right? Now, balanced DB, that's both. That's about 50-50 right here. Okay. This over here is a big summary of what's going to happen. So you can kind of look at that to figure out what it looks like. And then you hit this button and it's going to change everything. It's going to close everything out. Now what we're going to do is come down here and it's asking us, how much do you want to pay every month? So we'll come in here and specify the payment. And then we're going to say $200 a month. And it's going to show me that it's not doable based off of his age. Oh, I got to click this up here. There we go. It is doable. So now what we're going to do is run a report. And it's going to show me the max cash value. Oh, come on. Didn't close the window fast enough. And now it's going to lock up. Really? No, I can't get it to go anywhere. Okay. Are we doing it now? All right. Did my computer just crash? Okay, good. Here we go. Let me close this out. Let's try this again. All right. Didn't mean to confuse you, computer. Are you going to work now? There we go. Yay. Okay. So look, off the same amount, look at the cost of insurance. It drops to 80, almost 80,000. So now their cost for that cost of insurance drops. It's not 145,000 anymore based off of a $200 payment. Okay. Now they're going to grow cash value much, much faster. So we'll come down here and look at the illustration. Oh, that's the indexes. Let me keep going here. That's guaranteed. Okay. So based off $200 a month, he now has 19,000 in there. Whereas before, they got 20,000 in here. Now keep in mind, why is this still more? Well, they're putting in 232. Why don't we do this? Let's do it apples to apples here. Let me change this to 232.17. Whoops. Okay. Let's go down here. It's guaranteed. Okay. So right here, now he has 22,580 in here. Okay. Based off of a $232.17 payment. Okay. So down here, now he has 55,720, 73,000 in cash value. So based off of a $232 payment, now keep in mind, this is a 52-year-old male, right? So he's only going to be paying in for 20 years, right? This is year 20. After 20 years, he has 73,000 in there and $93,000 of a death benefit. Okay. Now, why would somebody want something like this? What if they just want to grow something so they can supplement their tax-free retirement and they don't have very much money, right? Maybe they don't want to do a mortgage protection. Maybe they just want to have a little bit of extra protection on the side, but more importantly, they want to grow their money tax-free. Now, how do you figure out how much they're going to save in taxes? Well, what I would do is I'd say, okay, grab a calculator, and if you guys have one, you grab one so you can do this exercise too. 73,000, I'd have them plug in 73,267 and multiply that times 1.3. That comes out to $95,247. And so what that equates to is if they had a 401k, they would have to make $95,000 by the age of 71 to be able to accumulate $73,000 of active income after taxes, because that's what they're going to pay in taxes, that difference. Okay. And where did I get that number? Based off of a 25% tax bracket. If you say 25% of state tax and 5% federal, that's about what it is. Now, most people don't know their tax bracket. That's the average. If they're in a lower tax bracket, you can say 20%, right? 15% for state, 5% for federal. But most people don't know. So that's their tax bracket. So that's kind of why I do 1.31. But if you look off of $232, they're going to accumulate some cash over time. Now, the death benefit goes up, Remember over here, we started at 93. The death benefit goes up. Why does it go up? Because the cash value is going up. If the cash value goes up higher than the death benefit, now we're talking about an investment, not a life insurance policy. And so by the death benefit going up, the carrier keeps it a life insurance policy for us. But as you pull out cash, this death benefit will go down. Okay. Now, if they want to see how much income they're going to have, all you have to do is come down here in distribution and solve for income. Now, you can't do this with Americo. Remember, Americo is designed for mortgage protection and an instant IUL. Somebody that just wants to build a cash value. Maybe they want some life insurance to cover something else. You know, maybe they want to pay off some bills. You can use an IUL for that too, right? So this will solve for income. A quick way to look at this without all of the jargon on the illustration, you can hit this quick view button over here, and it'll show you they're going to pay in until for 20 years, right? 71. After that, they're going to get a $6,360 check every year for the rest of their life. Okay. Now, if you run the illustration, you can see same amount coming out, nothing changes, right? Same amount of cash value. Now he's done paying it. Now he gets $6,360 for the rest of his life, and it comes off the cash value. But what happens is now he's compounding interest on this amount of money on the accumulated value, even though there's been loans been taken out. Okay. So that's the importance of the accumulated value, is because you're compounding interest on a larger number, because when you take out loans, it has to be a loan to be tax-free. So when you take out loans, you can choose, you're going to pay it back no matter what. You can pay it back when you're alive, or you can pay it back when you're dead. And if you don't pay it back while you're alive, it'll come off the death benefit in the end. And you can see the death benefit now is going down, right? Because you're taking out loans. So all of these loans that are taken out are calculated in this number. All the interest rate that they're going to pay is calculated in this number. Okay. Right here. Now, by the time he's 81, he's already taken out more tax-free money than he's paid into it. By the time he's 91, he's taken out 127,000. He's only paid in 55,000. Still has a death benefit of 31,864. Okay. So really, anybody that is within the age requirements and health requirements of the carrier can qualify for one of these. It's really that simple. So that's all I got for you guys. It's almost time for Grady's call, fflwatch.com. So just take these 2 hours every Thursday and just put them in your calendar and just take it as training every single Thursday, because the more you do that, the more you're going to learn, the more you're going to grow. There's so many times where I've been on a call and I'm like, I don't even need to be here. They're going over stuff I already know. But the more you do that and just plug it into your calendar, you're going to pick up one little nugget. It may be a phrase that somebody says that you're like, ooh, I'm going to use that. And then you use that and you help another family. Okay. So make this your number one priority, getting on these training calls. And you guys have a good day. I'll see you guys next week. I'll see you on Live Dials.
Thank you, Shawn.
You're welcome.